Welcome to NAIOP Solution Series program titled Food Distribution and Processing Trends. My name is Sandy Hudson, and I will be your host. The Solution Series programs are available at no cost to NAIOP members. These mini webinars run less than 30 minutes and are some quick tips and insights, all types of positive strategies and tactics to help you succeed in today's business environment. Is there a topic you would like to learn more about? Please send us an email to solutions@naiop.org to let us know what topics you would like to hear from in future programs. Please advance to the next slide. Some topics require a more in-depth discussion than we can cover in a Solution Series timeframe, and for that, NAIOP offers 90-minute webinars. These webinars are fully interactive and allow you to submit questions to presenters during the program. The next full webinar takes place on Thursday, December 8th. This informative program will examine the various sources of financing in the market today, as well as discuss how current deals are being structured and priced. The cost of the webinar is $65 for NAIOP members and $95 for non-members. To register for this webinar, just go online to naiop.org/webinars. Please advance to the next slide. And now let's get on with our program. With us today is Chris Cummings, Director of the National Food Advisory Team for Colliers International. This team specializes in refrigerated warehousing, food distribution, food processing, and dry food distribution facilities. The team's expertise in coordinating all technical experts, vendors, and consultants involved in the real estate process has earned them long-term multi-market assignments with leading food organizations. Chris's experience has earned him a solid national and local client base and prepared him well to understand the unique requirements of food distributors, manufacturers, and processors, and to deliver the best service possible. Welcome, Chris. Thanks for being with us today.
Thank you, Sandy, and thank you, everyone, for taking 20 minutes of your time to listen to me and look at this presentation today. The goal of today is to provide a very high-level snapshot, as Sandy mentioned, of the food supply chain. This is lessons that we've learned on our team from our clients over the past couple of years, and we're going to touch on each one, again, at a 50,000-foot view. But clearly, if you have any additional questions, you can reach out to us and dial further into each one of these slides. The food industry is a rapidly changing environment, and with that, so does the supply chain. Over the past couple of months, you've seen rising commodity cost, energy cost, and this all affects, ultimately, the margins that everybody operates within the food chain, all the way from the manufacturer to the retailer. So, technical advances and rising commodity and energy costs have led to newer, more modern facilities. Today, we will study what the food supply chain consists of, what construction and consumer trends are affecting building designs, and ultimately, what does the next 5 years look like for owners and developers looking to retain and/or win business from these users. This first slide focuses in on why do we, as our team, select to focus within the food platform. One, probably the most obvious, is it is recession-proof. As the population grows, the demand for food grows simultaneously. It's also somewhat China-proof, India-proof, although with the globalization occurring, we're seeing more importing and exporting from these countries than ever before with food. But most of the manufacturing is occurring here on United States soil. Secondly, there is little offshore threat, as I mentioned. Again, this is changing a little bit, but we're seeing this have limited effect. Thirdly, there are barriers to entry. What we see is that the capital intensity required to build out these facilities and the knowledge behind it seems to limit owner, investor, and broker interests. But again, today we're hoping to take some of those guards down. Constantly evolving supply chain. Consumer tastes are constantly changing. Oil prices, commodity prices are going up. So therefore, ultimately, it has an effect on the real estate footprint, not only where those facilities are located, but what is going on in the box. In January 2011, we signed the Food Modernization Safety Act. These are new government regulations that will have a ripple effect over time, but ultimately we believe that it'll lead to new facilities, more modern facilities, with companies that are operating older facilities to upgrade to more modern facilities. And last but not least is just specialization. We've heard this time and time again with different seminars that we go to, but specialization is going to be the future in the real estate business, and that is why we are focused on the food side. Let's take a quick look at the overview, as I call dirt to fork, of the supply chain. Each one of these sectors, so to speak, has its own supply chain challenges that affect real estate. The household names that you've got at the processor manufacturer to the distributor level, the Cisco's, the U.S. Food Services, to the 3PL distributors, everybody's familiar with Americold, U.S. Cold Storage, and then to the retailers where you go and buy your end products. Ultimately, the retailers, because of margin compression, are forcing very high-level technological advances, energy savings back down through the supply chain. So as the processors look to advance the efficiencies of their processing lines, meanwhile a 3PL distributor is saying, how I get the most pallets in the facility and have the lowest inbound and outbound costs ultimately. So it's causing a ripple effect across the supply chain, and we're seeing a lot of new projects come as a result of that. No one really knows the size of the market, because the market is measured in either by total cubic feet by 3PLs, and then there's everybody else. But this is from IARW and is a overall look. Obviously, you see California is leading the way in the amount of refrigerated space, and you can see the other states that follow by there. A lot of that's driven by farming, and a lot of that's obviously driven by population density within those states. One key item in all this is energy cost, and so we took a quick snapshot that looks at availability, looks at rents, and looks at energy costs for three big markets. And one thing when looking at this is both looking at freezer and cooler. So it's not just looking at one or the other, it's looking at them combined. In Southern California, you're looking at what is estimated to be around a 3% vacancy. And I would go so far as to say the vacancy that is occurring in all these markets is mostly in older 18, 20 clear kind of split freon, dilapidated systems that might have been built in the 60s and 70s. Across all these markets, there is very little, if no, vacancy in the tall, modern freezer cooler facilities. Taking a snapshot of the rates, you look at anything from a $9 rate for cooler in Southern California to a $5.75 average net rental rate in Atlanta. Conversely, if you look at freezer, obviously more expensive to build, you're looking at anywhere from $8 to $12 depending on location. And lastly, as I mentioned just a few minutes ago, the energy costs. The energy costs are significant differences. I mean, you're looking at 10 cents per kilowatt in California all the way down to sometimes 6 cents in Chicago and Atlanta. So again, looking at this is going to drive a lot of companies' evaluations and supply chain models because these energy costs are so significant in operating one of these facilities. Which leads us to this scenario. Assume for a second that you have a 280,000 foot 40 clear facility in California, and using a 10 cent per kilowatt, the total cost of electricity to operate that facility per year is $750,000. So if you came to Chicago or Atlanta or Dallas where the rates are less, you're looking at a 30 to 40% cut in that number. So when evaluating energy, this is important. Also, this is assuming an ammonia system, and with those ammonia systems, there's a decent bit of water usage. So I think looking out over the next few years, energy costs are going to be evaluated even heavier, and water consumption and availability is going to be looked at as well. Some general construction items. Again, the point of this webinar is to keep things pretty high level, but if you look at cooler rates do not have to, or cooler construction numbers are around $50 to $70 per square foot. Again, that depends on door, clear height, lighting, is it ammonia system, is it a split freon system, and items like that. So there are many variables that make up this number. Freezer, you're looking at $70 to $100 a square foot. One national client that we work with on a regular basis, when they're going into new markets, they underwrite $100 to $105 when they're chasing business to build a freezer box. And then, of course, you've got the retrofit. A lot of retrofits are occurring. This is not on the larger footprints. It usually occurs on under 100,000 square feet. So a lot of times they put a box in a box for a cooler. Or in some cases, they rip out the entire slab and put glycol on the floor and re-pour and put a freezer in there. So, to rip out slab, it's about $5 a square foot to rip it out and pour it back in. We're seeing this less often, but again, on the smaller footprint. What does the next 5 years have in store for food facilities? Again, we're going to touch on these again, but energy efficiency. Again, everything, all costs are trying to be, all margins are trying to be squeezed as much as possible. So to the extent they can make these buildings the most energy efficient buildings, they will with all new technologies. And those technologies include higher R values, thermal resistance obtained through better design, better materials, and better equipment. And the technology is changing so rapidly that there's a lot of focus being put on this. So new technology is coming out almost on an annual basis. With this energy comes the increased height of facilities. Again, the technology and design is there to where some of these facilities can go 100 feet tall. They can be operated on, with ASRS systems, and there's finally the ROI is finally there to implement these systems. So where you'll see this increased height of facilities is really with the 3PLs and ultimately with the retailers. Increased adoptions of ASRS systems. This was kind of 4 or 5 years ago, not talked about that much, and now it is readily talked about because it finally makes sense with the cost of these systems and how fast they are to implement these. The incorporation, as I said earlier, of the guidelines provided by the Food Safety Modernization Act, we think this will require, again, some older facilities to be upgraded. The key things with this act are really, the key focal points are really prevention and traceability. And as we all know, the food scares that we've occurred, whether it's the cantaloupes, whether it's the peanut butter, whether it's the lettuce, is accelerated the signing of this act. But it is probably the most important overhaul of food regulations since 1938. Now, it'll be interesting to see how it is implemented. And lastly, I feel like we're going to get into more creative financing solutions with this. Developers have been hesitant to chase or own this type of business because of the capital intensity. But what we've seen recently is developers basically signing a lease with a food company, and that food company paying let's say a $3 net base rental rate for the shell building, and then bringing in another financing solution based on that company's, that end user's credit, to take a second position, and then they outfit the remainder of the building. So for example, say you have a 300,000 square foot building, your base rental rate is $3, but the TI in that is $10 million. So that second, that person that takes the second part on the mortgage will finance that $10 to $20 million and pass it through to the rent. So arguably you're paying one to a developer and you're paying a return to another equity partner. Where does the opportunity lie? We feel the opportunity lies in port locations. A lot of that port locations tend to be on the East Coast. The West Coast seems pretty mature with the freezer cooler availability. I still think there'll be opportunities there, but I think the East Coast is yet to build out quite the infrastructure, and I'll get into more of that in a second. Private label companies. If you look at any trending of the growth of these companies from 2007 through today, their growth has been off the charts as people are looking to save money at the grocery stores and buying a lower price item from a private label company. West Coast companies looking east. We had a lot of clients in 2008 starting to look east because of what the price of oil was doing. But the recession hit and they scrapped those plans. Well, they realize now that the oil, this is a little bit of a new norm, and therefore they can't continue to manufacture and distribute just out of one West Coast location to feed all the people on the East Coast. So we were seeing a lot of companies starting to poke around and actually, as I'll get into in some studies after this, actually implement their plan and either buy, retrofit, or greenfield a facility on the East Coast. Manufacturers co-locating. This is, again, if you talk to the Crafts and the Campbells and everybody, one unique thing that's coming out, and this is a result of a paper by Andrew Lazar called Frenemies, and he was with Barclays. He's a head food analyst. But because supply chain cost, real estate cost, oil costs, transportation costs are so much, there's an argument that the ConAgras and Kellogg's might share distribution facilities going forward. And although that seems crazy that competitors would share facilities, they get the advantages of shared costs on facilities, shared costs on labor, and ultimately shared costs on taking full truckloads to the end retailer. We're going to see 3PLs continuing to grow as outsourcing continues. And again, they're going to be on the front edge of this technology, of these tall automated facilities. So we don't see the 3PL growth slowing down at all. And last but not least is, with the USDA regulations, the Food Safety Modernization Act, and quite frankly, energy costs, we're going to see companies relocating from 18 to 20 clear to more modern facilities, and we see a significant opportunity there. It's not going to happen overnight, but companies have got to decrease their costs and either consolidate or become more efficient. And to do this, they've got to go to a new facility out of their older facilities. Some recent examples on some of the things that I have touched on throughout this presentation is Americold. Americold is the largest cold storage 3PL operator in North America. Again, on the front end of technology, they're in the process of building a 110-foot clear building in Indianapolis, Indiana. This facility will be completed this year. Touching on the energy efficiency side and green lead side, General Mills, they completed a new 1.5 million square foot distribution center outside of Atlanta. Again, the aim was to reduce their environmental footprint and distribution costs. It is the largest LEED Gold certified building in the U.S. and the second largest in the world. An example of a West Coast company moving east due to a myriad of things, one being transportation cost, one being energy costs. Amy's Kitchen, they recently purchased a Sara Lee plant in Greenville, South Carolina, which they're retrofitting, and that will be completed at the end of this year. And Kroger, obviously a household name, one of the largest grocers in America, is rolling out these higher cube automated facilities. They're on their third one right now in Compton, California, and they will continue to roll these out throughout the East Coast because of the savings that they're generated, the savings that are generated from this. So those are just a few examples. We are working with a client that, again, is a West Coast client that is looking east to build a processing center. And all of the items that I mentioned are occurring with many companies across the food industry. Please let me know if you have any questions for me or our team. We're happy to answer anything that you might have, and appreciate you taking the time to listen to this presentation today.
Chris, thanks for a great presentation and sharing your insight on current and future food distribution and consumer trends. Our next Solution Series program will be available on December 13th. Watch your email for NAIOP Source or corporate e-newsletter for the program link. Thank you for listening to our session, and have a good day.